Hello everyone! Thank you for watching our presentation. My name is Aritro Chakravarty, and today I'll be discussing a key concept in investing, assessing risk tolerance. In this channel, Creating Lasting Investments, we will teach people of many levels about investing and finance. So understanding your risk tolerance is vital for making smart financial decisions, whether you're just starting out or planning for the future. In this presentation, I'll cover what risk tolerance is, why it matters, and how to align your investment choices with your comfort levels and goals. So, let's start with the basics. What is an investment? In simple terms, it's putting your money into some assets like stocks, bonds, or real estate, aiming to grow your wealth over time. Each type of investment has unique characteristics and potential for returns, which is what you get from your investment. Investments can grow in two main ways: through appreciation, where the asset increases in value, like a stock going up, or through income, such as dividends or rent. And by the way, dividends are payments made by companies to their shareholders from their profits. For example, you could earn dividends from stocks, or you could earn rent from real estate properties. There are different types of investments. Real estate involves owning property, like houses or buildings, with the hope that their value will increase over time. Short-term investments or cash investments usually come at lower risk and lower returns, like saving accounts or bonds, but they provide steady, low-interest income. For both individuals and businesses, investments help build wealth and provide long-term financial security. Next, let's talk about risk tolerance. It's basically how much risk you're comfortable with when you're making investment decisions, both financially and emotionally. Understanding your risk tolerance helps you pick the right types of investments. If you're okay with more risk, you might choose investments like stocks that have the potential for higher returns. If you're more cautious, you might go for safer options like bonds. Knowing your risk tolerance is key because it helps you match your investments to your comfort level, reducing stress and helping you make more calculated decisions, even during market ups and downs. So, what are the types of risk tolerance? Well, first, we have aggressive investors. They're willing to take higher risk for chances of bigger rewards. They're comfortable with market ups and downs and focus on growth, often choosing stocks and equities. And equities, by the way, refers to ownership of an asset, such as a company. When you own equity in a company, you own a portion of that company, typically in the form of stocks or shares. Equity can increase in value if the company grows and performs well, and vice versa. Next, there are moderate investors. So these investors balance risk and reward. Aiming for steady growth while managing potential losses. They typically create a mix of stocks and bonds, like a 60-40 ratio, to maintain some safety while still having room to grow. Finally, conservative investors focus on preserving their capital. They're less concerned with high returns and more focused on keeping their money safe. They choose lower risk assets like bonds or cash equivalents, which tend to be more stable but offer lower returns. So let's quickly go over what affects risk tolerance. So first, the time horizon. Longer timelines mean you can handle more risk. For short-term goals, less than 3 years, stick to safer options like cash or short-term bonds. Medium term, 3 to 10 years, allows a mix of bonds and stocks, while long term, 10 plus years, is great for higher risk assets like stocks and real estate. Secondly, goals. Your financial goals dictate the risk level. Emergency funds need low risk, but long-term goals like retirement can afford higher risk. And the three steps: just define your goals, choose a strategy like growth or safety, and set a workflow. Track your progress and stay on schedule. Clear goals and timeline make all the difference. So there are a few factors that can affect your risk tolerance, starting with age. Younger investors usually have more time to recover from losses, so they can typically take on more risk. So next is portfolio size. If you have a larger portfolio, it can better absorb losses, which means you might be able to take on a bit more risk without jeopardizing your overall financial situation. And finally, another factor is comfort level. Some investors are naturally more comfortable with risk, while others may feel more anxious about it. This varies from person to person, and it's important to know your own comfort level to make decisions that won't cause unnecessary stress. So, how will you personally benefit from risk tolerance? Well, first, it helps you make informed decisions, clearer choices that reduce stress. And secondly, it supports a balanced strategy, mixing safety and growth to manage risk effectively. It keeps you goal focused so you stay on track with long term objectives, even during market swings. The benefit: you minimize risk, maximize returns, and avoid emotional decisions. Long term success becomes more achievable with diversification, flexibility, and solid risk management. However, let's talk about some downsides of not aligning your risk tolerance properly. First, miss gains. Being too conservative might limit your potential earnings, as you may avoid higher risk, higher reward investments that could offer better returns. Also, overconfidence comes with taking risk. If you're too conservative, it might limit your potential earnings. If you're overconfident, you might take on too much risk, leading to poor investment choices that don't pay off. Finally, emotional strain. Misjudging your risk tolerance can lead to stress, especially during market downturns, when you may feel anxious about losses you're not prepared for. So, to manage risk effectively, here are two key strategies. First of all, diversification. Spread your investments along different asset types, like stocks, bonds, and real estate, to reduce risk. This way, if one area underperforms, others can balance it out. Secondly, asset allocation. Choose the right mix of assets based on your risk tolerance. For example, more stocks if you're willing to take on higher risk, or more bonds if you prefer a safer approach. Additionally, here are two more strategies to manage risk. So, dollar cost averaging. So this means you invest a fixed amount regularly, no matter the market conditions. This helps average out your cost over time and prevents emotional decision making during market swings. Also, reevaluate your risk tolerance periodically, especially when your financial situation or the market changes. This ensures your investments still align with your comfort level and goals. So, in conclusion, understanding your risk tolerance helps you make informed decisions that create a sense of security for your financial future. Personally, I strongly believe in the value of having a clear risk tolerance because it supports planning for a positive and ambitious future. By knowing your risk tolerance, you can maximize long-term profits and make decisions that align with your goals. And thank you for watching, and this is Creating Lasting Investments with Aritro.